So when we're looking at inefficiencies, if there's an inefficiency like this little gap here, this is what you see as the gap. That is not it. This is the wick. So real time, I told you, focus on that. Okay. Now, does Chris Laurie teach this? Does Wyckoff teach this? Does supply and demand teach this? Does Elliott Wave teach this? Does anything else? When we have a PD array or a range that we're looking at, a very specific range, price goes up and can't even accomplish getting to the high of it. You see how that wick falls short of the closing, or I'm sorry, the opening price of that candlestick right there? You see that? When it does that, that's proving heaviness. Heaviness is bearishness. It's not showing strength to continue higher. Where does the body close? It's below consequent encroachment of that wick. That is what? Heaviness. It's not bullish. Okay. So the market creates this little run here, falls off, and it attacks the sell side that I said that existed below these lows right here. Okay. For the guy over there on the Wall Street. Okay. Supposedly said that there's no liquidity sweeps. Well, I called it live, and it went down there and hit that. Then what does it do? It runs right back up to first presented fair value gap, but it's being shown to you as a wick. So stop teaching my shit and selling it because you don't know what you're talking about. This wick here, it trades right back to it again. It goes into its upper quadrant, but the bodies are now where? It can't even stay inside of that wick. Is this bullish or bearish? Bearish. Why? Because ICT, Inner Circle Trader, Michael Joe Huddleston, okay, the, the, the real McCoy told you that real order flow can be visually seen in the candlesticks. If you know what you're anchoring against, you don't have to pay for these gimmicks. You don't have to pay for some level 2 data. You don't have to pay for some software package. You don't need to look at heat maps, bubble maps, bullshit. Okay. You don't need any of that stuff. You can sit down and look at just open, high, low, and close in a candlestick and see everything that's going to happen before it does. Just reading price through the lens of time, then price. Once we have those two, then we can measure premium to discount, sensitivity. Can't even leave a body up here. It's burying the bodies in the lower half. That's what you want when it's bearish. It can't even leave the body up in here when it retraces back up to it. That's what you want. That's bearish. Here, trade up in here. Can it get back inside of it? Nope. Is that bullish or bearish? Bearish. Consequent encroachment of the opening range gap for regular trading hours. That was this level down here. That's what I told you I was looking for. Now, there was another level I said it could get to. It could take this, but I said it might not, but I'm confident it's going to trade here. Go back and watch the live stream. I was not calling both sides of the marketplace. But that consequent encroachment level, that's your first draw. And if you have a price that's opening here and it starts to rally up like that, man, that's wonderful. That's wonderful because what that's indicating is this run is a Judas swing. It's fake. And all that's doing is opening up more potential profit, more range. When it starts here, it could open right there and go right down to consequent encroachment. Many times it does that. In fact, we saw that once this week in one candle. The first one, boom, went right up to consequent encroachment. Done. It's over. What do you do there? Well, just relax. But when you have opportunities like this, where it opens, it runs higher, you know what it's doing. It's setting up a chasing. Retail's going to want to chase that. They want to be buying a breakout. They want to chase price. Now, if you take this, the lower quadrant and the next octane above it, and what I'm measuring here, I'm going to take this off just for a second so that it cleans it up. This is an octane on the suspension block on the daily chart. This is the lower quadrant of it. This is the lowest octant level, and this is the low of that suspension block. Price pierced this high, this high, this high at a time when the market was bearish. It was likely to draw into its regular trading hours opening range gap. The market was decoupled. Knowing that we were looking for relative equal lows, lower than these here, lower than that one, trading lower. This is manual intervention. They run it up, but it's not to some random level. Phil is not sitting here saying, let me just take it to, I like this number. That's not what he's doing. Okay, that's not what he's doing. The manual intervention still always goes to a level that's algorithmic. It always will do that. It will always do that. The problem is it's going to go to one that you didn't personally expect to happen right when you start watching price action. That's what makes it dangerous. And manual intervention can come out anytime. That's why you have to use a stop loss. That's why I tell you don't over leverage right now, because it's happening more often than normal. Okay. Usually you might get 2 or 3 times a month in normal market conditions. Okay. Normal. And many of those instances are actually scheduled. Okay. So that's around the economic calendar. So by measuring when prices in a large range like this, the larger the range, okay, the more opportunity you can divide and reduce the gradient levels. So an octant is an eighth, okay? You can split that between the quadrant and the octant, and half of that is what's being measured here. Did I grab it? Yeah. So I'm just going to rough eyeball it there to there. So there's the midpoint. This is event horizon. Whenever you have a wide enough range separation between a PD array, an old low, a imbalance, a gradient level, always look for that gray area in the middle. It doesn't exist in the chart. There's nothing else out there. It's like the void. Okay. It's the ether, but there's something staring back at you in it. It's the event horizon. And price goes right up in there. Phil takes it right to it, books it. But now look, what does ICT teach with real institutional order flow? If you can identify a PD array, if you're bullish, it should not touch it with the body or lay a body on it. The wick can touch it or fail to touch it. That's bullish. If it's in the upper half of it, that's discount sensitivity. That's bullish. Here, what do we see? Price wicks to it, a little bit past it. That's permissible. Where's the bodies? Not touching it. They're both below it. Is that bullish or is that bearish? Bearish. All during this time, I was ranting and raving in the Traders Roundup. So that's a little bit of regret on my part, because I would have loved to be able to say, look at the price action right now. And if you listen to the rant, we were about in here. I said, we're going to go down and clear out that 25,260 sell side. Those lows right here that I gave you during the live stream when we were here. And the market went down, consolidated a little bit in here, and then dumped aggressively, cleared it. Okay. So manual intervention is not going to random levels. It's still going to go to a level that you can find within real order flow with my concepts. There's going to be a PD array that's anchored right to that. In the beginning, you're not going to anticipate those things correctly because you don't know what to do with them. It'll probably be 10 years before you would be able to find a setup like this. So don't demand that you know how to do it in the first 6 weeks. Some of you are absolutely expecting to learn how to do this stuff. And that's why most people say, oh, it doesn't work, because you don't know how to use it, or you know that it's going to take you more time and you don't want to spend the time doing it because you're lazy. And I'm not going to apologize for that, because it took me a lot of time to get to it too. A lot of work, a lot of effort, a lot of doing it wrong, reading it wrong, But most people, when they first start, they don't have the wherewithal. They don't have the conviction to say, I'm going to go through this come hell or high water. I know it's going to be hard. They're the same people that will join college on a free ticket scholarship. And because it's too hard, they quit. Or their parents paid for it and they still quit. That's a piece of shit. That's somebody that's not worth doing anything with. And if you think that way, you need to change the way you think. You need to be able to see this and say, this is an opportunity. I'm going to pour myself into it. Come hell or high water, I'm going to do it. And I don't care how hard it is. I'm going to get to where I want to get. And I'm not going to stop until I get there. Because you're already doing that anyway. All of you are doing that with something else. You're grinning and bearing it. You don't love doing it, but you're still pushing yourself through it. You're all working towards retirement. Either death takes you out of the game or you achieve it and you live on some kind of low income subsidy, if you even get that. But that's what all of you are subscribed to. You hate going to your job. You hate the people you work at. You hate that you don't make enough money, but you're still doing it. You're still committed to it. You work all week to get to these 2 days, and then you blow what a little bit of money you make. Why don't you take that same measure of conviction and apply it to this? And you'll probably stop doing what you're doing right now and bring retirement closer to where you are. Just a suggestion. I mean, I don't know. Maybe some of you might listen to that.